Hi everyone, it's Alex here at Sestrin Capital Research. Welcome to our Growth Investor Pro weekly webinar. It's Thursday, the 21st of September, 5 p.m. Eastern for the benefit of the tape. Okay, so let's do just a first of all level set. So obviously everyone is freaking out. The world's going to end, all of that, even though the NASDAQ is where it was on the 23rd of August. I'm a member of a couple of stock services, as some of you know, and not very many, but the ones I see, everybody's chat room is freaking out because the market's down and the Fed's going to ruin everything and the 10-year yield is up and blah, blah, blah. So it could be that we're all doomed and it's all going to zero, but it probably isn't. And so what follows in this webinar, the background here is our ongoing work that says that we continue to be in a bull market. This is a pullback like any other, in our opinion. We could be wrong. If we're wrong, well, we'll change our stance. But what follows is all based on the assumption this is a pullback. So what we're going to do today is cover the following things. We'll do our usual disclaimer in a moment. I want to run through all 4 US equity indices, the S&P, the NASDAQ, the Dow, and the Russell 2000. We'll look at the medium term, look at the short term, and then I want to look at which tech stocks are in our accumulation zone. And the reason to do that is because times like this, when everyone's freaking and screaming and running for the exit and all of that, these are the times to be accumulating stocks usually. Again, it could be wrong, but usually when it feels like this is a good time to be picking up the good companies at the low prices. Now, last time it was like this was the second half of last year and early this year, and the stocks that were in accumulation zones then, many of them have moved up pretty dramatically, some of them which we've since taken profits on, whether it's that in staff personal accounts or notionally in the service. But there's quite a few left that are either still in or have returned to the accumulation zone. I want to focus on those. And the reason to focus on those is precisely because everyone's freaking out and has decided that the market's going to go to zero. So, if worried, you can always go to cash or short or hedge or do whatever you need to do. But equally, you should be looking with clear eyes whether you should be buying things. And only you can decide that. But our job is to present some opportunities in that regard. So before we do any of that, let's do our disclaimer. As always, house rules here. So we run on a live and open mic basis. If you have any comments, questions, things you agree with, don't agree with, things you want to shout about, scream about, then a number of ways to do it. Either open the mic and shout into the system. That's the best way. Then everyone can hear your comments and opinions. If you don't like to use audio or you're in a place where you can't do it, then the next best option is type into the Growth Investor Pro members chat room. I have it on my other screen here. I can see the questions as they come up and read them out for everyone else's benefit. Or if for some reason you can't do that, then use the questions or the chat in the webinar system. But if possible, use the Growth Investor Pro chat room because everyone can see it there. Okay, so let's do our disclaimer. Disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's do the equity indices. Let's just switch screen right here. Okay, so here we go. So let's go through, first of all, the larger degree picture for each of the 4 major equity indices. At times like this, when emotions are running high, then personally I always find it helpful to zoom out and just step away from the fray and see what's going on. So, we've gone through the history of this chart a lot on recent webinars. We don't need to repeat that now. Safe to say that our base case here is that we're in a 5-wave up cycle that started back in 2015-16 on the S&P, that reached a wave 4 low in October 22, and that we're currently in a wave 5 high. And if we're in a wave 5 high, then we can expect to see this wave 5 peak at least, let's call it 485, 500, which would just say just a little bit above this wave 3 high, but more likely if it's a wave 5, somewhere in the mid 500s between the 61.8 and the 78.6 extension of this wave to 1 to 3 combined, place to the wave 4 low. So the question is, does anything in this picture look like that's not going to happen? Well, I think if you're going to find evidence to the contrary, you would probably say this. I think you would say that this right here, these volume bars here, this spike up in volume, you would say, well, I wonder if that's distribution. And I think to work that out, you would have to do this. You'd have to say, well, let's set the clock at the October lows. And let's say that these grey bars here are only showing SPY trades from October 22 to date. And I think if you were going to construct this argument that says, the top is in fact, 2021 was a top, and this has just been a big bear market rally, a giant B wave, and now we're headed, down to the basement, down back to, 300 on the SPY or something, then I think you would probably make this argument. You would say, well, okay, there was a lot of accumulation. And you would say something like this. You would say, well, let's start the clock at the wave 3 high. You would say, okay, between May 22 and around February 23, there was a ton of accumulation, and folks are buying the S&P in bulk between, let's call it 380 and 415. And then you would say, well, let's move on and let's look at the clock starting at the lows. And you would say, well, look, this up here, this is distribution up here. And so folks that were buying between 380 and 415, they're selling between 430 and 460. And you could be right. Yeah, and I have no definitive evidence to say that's not correct. But I think you'd have to ask yourself, why would that be? What is this volume spike here? This volume spike here is likely to be institutional trading. It doesn't look like retail. It doesn't look like high frequency or momentum type hedge funds. Volumes of material. So I think you have to say to yourself, well, why would institutions be selling here? Now, for this to be institutional selling, something would have to be fundamentally broken in the market and about to get worse. So the reason they were selling up at the top back in 21 was the pending and then actual rate hike cycle. And with that, the tightening of monetary policy, the reduction of available capital to flow into risk assets, and the sell-off that came. And the reason that from May 22 to March 23, you got this big accumulation down here is what? It was that the market was in a bottoming cycle, that at least if you were a big money institution, you had a good sense of where the Fed's terminal rate might be, and you could smell the fear in the street and you were buying. So if you were doing that, why would you be selling now? GDP, well, US GDP looks good. Broken labor market, well, labor market looks good in balance. Wage growth isn't too bad now. Broken inflation, inflation's coming down. Endless rate hike cycle, well, the Fed told you yesterday that probably they were done. I know they left the door open for one more raise, but they said that last time, so there's no new news there. Why would you be selling here? I can't think of a reason. Now, it could be that they know something we don't. Perhaps a large bomb is about to land somewhere in the world that's going to harm us all. I don't know. But my guess would be that this is accumulation. And I would guess that it is twofold. It's either those people that didn't believe that this rally was going to happen. I don't mean retail or smaller funds. I mean big money funds. Let's say that there is a fair number of big money funds that got this rally wrong, and we know that that's true. then wouldn't you think they would give themselves another go to pick up stock before another run to the highs? And the S&P is a good proxy for the market as a whole. My own view is this is likely to be another round of accumulation. Either the same folks who bought down here, or folks that missed out down here didn't believe this was going to happen, and then they've been given the gift of a big sell-off, which people are freaking out about. There's no reason to freak out about it. The S&P is at a level it was on the 13th of August, and before that on the 18th of June. And no one was freaking out then. I'd never watched CNBC or any of these things, but my guess is all over it. You'll be seeing bad news everywhere. So my guess is that's accumulation in the S&P, and my guess is we are going to run on to see new all-time highs. Let's look at the Nasdaq. It's the same story. So this is our base case. We've set out on previous webinars a much more bullish case that's possible, but let's stick to our base case for now. Does this look like a topping and a reversal? It doesn't look like it to me. Just look at the chart. Forget any technical analysis. Just look at what it's doing. It's just pause for thought for a moment. If you went back to January this year, so the Nasdaq shot up from December into January and then sold off into March. And so that sell off there, again, you were seeing all kinds of freaking out then. And so, there the QQQ dropped from 313 down to a low of 285. Let's call it $30 a share. And now we've dropped about $30 a share, which is obviously a lower percentage amount. And so again, to me, this looks like we're in some sideways action now that's been sideways since June, a run-up peak in July, but otherwise, sideways run of accumulation in my view to catch the next run higher. A word here, by the way, on short-term charts, which is for those of you that are in chat, and if you're not, do try to join the chat. There's a lot of stuff there. Fred Frog, which I suspect is not our user's real name, but Fred Frog called very nicely a mid 350s termination range for this. And of course, it could well go lower. But if we find support soon, and I suspect we will, that's been a pretty great call. Fred is very, very, very good on something called C waves, by the way. So I encourage you to always look out for Fred's work. It's excellent. So that's the Nasdaq. So again, it's the same chart as the S&P. Timeframes are truncated, amplitudes are extended or expanded, but it's the same chart. And so again, it could be that this is the big stumping, but I don't think it is. I think it's the second bite of the cherry, freak out the civilians, scare everyone, pick up some stock before the next move higher. Dow, I mean, what's scary here? Nothing. There's not even, you can't even point to any major volume up here. This is not volume selling up here. You've got accumulation in this range here between on the DIA around 326 and let's call it 345, and then very little volume at all from 345 up to the current 355. The Dow has been sort of led the way really of the recovery since the lows. As you can see, it ripped up out of the lows in October faster, excuse me, than the Nasdaq, faster than the S&P. And even if you don't invest in the Dow, it's worth watching to see what it's doing. And even though it's notionally a sleepier index, it can often lead the way. Russell. Russell continues to move sideways in this accumulation zone here. So it's peaked out 3 times, August last year, January this year, July this year, and so far it continues to follow a lower highs, breakout there actually, but lower highs, higher lows, which to me is a consolidation pattern which I expect to resolve to the upside, and I expect this to resolve up and to move up to this markup zone. And if it does, well, you can see what happened in the last markup zone, which is a very rapid move up, and I believe we may see that again. Financials affect the Russell disproportionately compared to the other indices. If and when rates start to, in fact, fall, financials should benefit from that. And so I see no reason not to be medium-term bullish on the Russell. Now, of course, anything can happen tomorrow. Market can drop tomorrow, but zooming out and just getting a bit of perspective here, I personally remain pretty sanguine about the direction of markets. Let's look shorter term. This is the S&P. So this is, we use the futures for the shorter term charts, more trading data. So we're in the middle of a large degree wave 3 up. If you look, this is the S&P from the October lows. So we had a wave 1 up, a 2 down that troughed around the 61.8, retrace of that wave 1 up, and we're now in this wave 3 up. And so far it's had a 1 up, 2 down, 3 up, 4 down within this wave 5 wave cycle. And we've yet to retest this wave 4 low here. But if we do retest it at 4,300 or thereabouts, that's still a pretty shallow. Look, that's a shallow wave 4. You could argue that the on the futures you could drop all the way to 4,200 pretty much and still believe that this was a bullish pattern. So there's no reason to freak out at this point in time. If this pattern holds, then we'd expect to see this wave 5 reach 4,900, something like that, which would be a new all-time high. Before then, another sell down and then another move higher. So that's the S&P. NASDAQ, again, same story. Here's the shorter term play. So this is since the January lows. Wave 1 up, really shallow. Wave 2 down, just a 0.5 retrace. 200% wave 3 extension up here, shallow wave 4, 38.2 retrace. And again, look, this wave 4 has not been retested. So again, you could see the NASDAQ drop to the mid 14,000s. I mean, in truth, really, technically, it could even drop to 13,000, and this would still be a righteous chart. The only meaningful rule here about a wave 4 is that it shouldn't go much below the wave 1 high. So it would be uncontroversial to my mind if we retested the mid 14,000s before another wave 5 higher. And again, this wave 5 higher, if that happens, can see the NASDAQ reach new all-time highs. Dow, by the way, all the trade notes on here, this is from our Inner Circle service where we trade the triple index ETFs, and we set out forward trade plans, and we say what we're going to do with the longs and the shorts ahead of time, and we update on these charts at least daily. Dow. So here's the Dow from the March lows, a nice 1, 2, 3, 4, 5 wave up that finished in June, and then an A, B, C correction, and we then started a new wave 1 up. 2 down, 78, actually quite a deep wave 2 there, a bit more than the 78.6 retrace. Now looks like we're in a 3 up. That'll probably take a bit longer, I guess, to play out. But again, there's nothing here. This wave 2 low has not been retested. So if the YM futures went down to, let's say, 34,000, again, there's nothing here that breaks this chart. So if and when these charts break, okay, we'll reconsider. But right now they haven't, with one possible exception, which is the Russell. Okay, so this is our short-term Russell chart. We use the RTY futures here. Now this is a bit ugly here, this wave 4. So yesterday's close saw this wave 4 right around the wave 1 high from back in May. And so really, if this was a righteous chart, you'd expect that to have found support there and bounced. Now, if this bounces tomorrow upwards, okay, it's not the world's best chart, but it kind of helped. But I think what we have to consider is, well, maybe this chart is just wrong. And in fact, it should look a bit different. So let's do this chart again to see if this is true. Now, even if you don't follow the Russell, it's useful as a leading risk indicator. Very often the Russell and the Dow can take off before the S&P and the NASDAQ. So let's just do this all again from here, from this May low. And let's say we have this wrong. Let's say, in fact, that's a wave 5 high right there. So it must have gone something like this, right? So that must have been a wave 1 and 2. That must have been 3. And it could be a 3, look, 1.618 extension hit right there. You have a wick there, but if you look at the close, the daily chart, the closing hits the wick there. This would be a wave 4. Yeah, retest the wave 1 high, so that could be. And then this here would be a wave 5. Like that. That's a big wave 5, but let's say that's right. So it would look like this. 1, 2, 3, 4, 5. It's not a wonderful chart, but let's say that's right. And let's say we're in a big ABC correction right now. And so this would probably look something like this. You've got an A down here, a B there, and a C down here. And very often what you find, let's say it's a really brutal correction. Now, very often what you find here is, let's find the right tool. For some reason I can't find it. Here we go. Very often what you find is an A equals C correction. So we got 190 drop there, and 190 drop there. So yeah, so we might see the RTY head down as low as 1750. Now, if we do see that though, then again, having zoomed out and thinking about the long term, then what we'll start to see then is the start of a new wave 1 up here, where again we can just expect a 1, 2, 3, 4, 5 waves up. So the thing is, even if the Russell sells off further, then it means that our prior chart was wrong. That's not a wave 3 high as we thought, but that's a wave 5 high. Okay, that happens. But we still don't see any reason why this would just continue to sell off and down. We would still say zoom out, and if you were to look at what that would mean for this IWM chart, you would still see the IWM within this accumulation range. So when we look at any fundamentals in the US economy, if we look at GDP growth, inflation, corporate earnings, consumer wealth, any of the fundamentals, inflation, rate outlook, anything, we don't see any reason to become structurally bearish. And if we look at the charts, they all look like pullbacks to us. Now, we can be wrong, but do your work here before you conclude that the market is doomed. And you have to do it calmly, with some distance, and not with CNBC or Twitter blaring in the background, because nobody can think straight when that's there. That's the reason that they're on, right? They are there to stop you thinking straight, make you do dumb stuff. So that's our index outlook. Before we move on to single stocks, if you have any questions, points, comments at all, as always, just shout into the system if you can, or alternatively, you can post questions or chat in the system or in the Growth Investor Pro members chat room. Okay, stun silence.
Alex, do you hear me?
Yeah. Hey, yes,
Thank
who's
you.
on?
Tom,
Hey, Tom.
just wanted to test it. It didn't work last time.
Yeah, go ahead.
I'm good.
Okay. Okay, so we have a question in chat, opening a new TZA position. No, I'm not, to be honest, because I think that, no, I'm not. I think if I was opening new positions, they will be long at this stage. So, I mean, as always with these things, everyone should do what they feel comfortable with. If you're worried about a big drop from this point, then hedging is always a sensible move to take. To protect your positions, all of that. But no, I'm not. And that might prove to be wrong, and maybe I have to in the end and have to do so at a lower price. I don't know, but no, not right now. Okay, let's move on to single stocks in that regard. So let's go back to our presentation here. I'm just going to switch screen. Okay, let's go back in time a little bit. Okay, so the last time that there was this level of freak out was at the end of last year and the early part of this year. And at that time, we had a whole bunch of tech names rated at accumulate. And I've just listed a few here: NVIDIA, Microsoft, MongoDB, Marvell, Meta, Dynatrace. There's a ton of others as well. And that wasn't a desperately popular thing to be saying at the time. But the reason we were there was it looked at technically, the markets had sold off a lot, like a lot. It looked like they were finding support, and earnings were just starting to bottom out and think about turning around. And not every stock we had rated at accumulate at that point is up, but across the board they are, and some of them have been outstanding performers. So I just picked a list of great ones and okay ones here. So NVIDIA, of course, everyone knows about. Meta Platforms, Meta Platforms was trading at 7.5 times cash flow a year ago, and nobody wanted to buy it, which is insane. It's up 100% since then. MongoDB up 61%. It's been higher as well. Microsoft, Microsoft is the easiest stock in the world to buy and own. 36% up in the last year. You can just park money in it, and it's paid you 36%. This is a total return calculation, by the way, includes dividends. Not much dividends in these things, but there is a little bit. What's next? The Nasdaq itself up 28 points in the last 12 months on a total return basis. And then Dynatrace, it's actually underperformed the Nasdaq, but still 28 points. And then Marvell had run up quite high. It sold off a bit, now at 18 points. So all these names that looked, unbuyable, crazy, all the rest of it, back in 2021, have done pretty well, very well in some cases. And that was the free money time. And the reason it was the free money time was no one wanted to buy this stuff. So if you fast forward to now, a lot of these names have run, and is the risk reward in NVIDIA or Microsoft, is it ideal now? I don't believe it is. I think that the screaming time to buy those has passed. But there are some other names that are looking pretty good from a risk reward perspective, in our opinion. Most of the stocks we cover now in tech are in markup. Now, if you are new here or you've not come across this before, we try to use this Wyckoff motif in our work. So this is an idealized method. A lot of stocks do look like this actually, but it's an idealized form. And so this is built on the assumption that for big liquid stocks like Microsoft, if you're a large account fund, a truly big money fund, you can't make money by picking up stock in Microsoft quietly and hoping it goes up and then selling it again. And you certainly can't do that in small caps, because if you do that, if you start to buy in volume, you'll move the price by yourself. So the Wyckoff rotation idea is that, well, big money encompasses this and embraces it and says, sure, if we break cover, we're going to move the stocks that we're buying. And so the notion here is that when you see sideways action at the lows, this is accumulation. So slow buying, slow building up a position, trying to not let the cat out of the bag. When you see this rapid move up through the markup zone, well, big money's finished buying here. This is late money. This is momentum hedge funds who do know what they're doing, and retail that usually doesn't. In fact, retail is usually buying right up here when big money is putting sideways action in at the highs. You heard me mention earlier this question of whether in the S&P or the Nasdaq the volume spikes right now, distribution or accumulation. And you can see why it could be distribution, because we've moved up from earlier in the year. My own view is it isn't, but this is the whole point, which is if you call that wrong, you're in trouble, because if what you're doing is buying when the bigs are selling, well, then you're just providing liquidity to the bigs, and that's unlikely to end well for you. It will end well for them. Markdown is the point at which large accounts have finished selling, there's no more buyers, and the stock will fall pretty hard. Rinse and repeat, right? So most tech stocks that we cover are in this markup zone where they put in sideways action at the lows, in many cases from April till even May, April last year to even May this year. And then they've moved up sharply as basically all over Twitter and CNBC earlier this year. It's AI boom, 3,000 other reasons to buy tech stocks. and along comes late money and bids these things up. So most are in markup, but it's why you see most of the tech stocks we cover rated at hold right now. It's not that they can't go up, sure they can, but the risk reward to us is not as good as it was earlier in the year. But there are some that we do rate at accumulate, and I want to walk through the charts for these. I don't propose to walk through the fundamentals. If you look at the earnings reports that you can find in Stock Central and click through to the earnings reports, or in the service, just type the ticker into the search box. They don't bring up the earnings reports. You can look at them there. But let's run through each of these and have a think about whether they're compelling buys right now. Let's start with Autodesk. I'm just going to switch screen again right now. Okay, so let's go to Autodesk. Okay, so this is Autodesk. You'll be familiar, I'm sure. Dominant CAD software business, computer-aided design software, serves the building industry and 101 other industries. Long in the tooth business, which went through a big transformation in 2018 from memory, moving from upfront upfront perpetual licenses to subscription sales, assisted by, if I recall correctly, Elliott Advisors, and now has a really, really nice recurring revenue model, high margin business, really good fundamentals. So the stock put in from the January 18 lows, a really clear 1, 2, 3, 4, 5 waves up that peaked in August 2021 at $344 a share, up 3.5 times your money from February 18 in just over 3 years in what was essentially a legacy software stock. So this is the reason to catch the risk reward on these things well. If you catch these things at the lows, even in relatively boring companies, you can make great gains. Then puts in a 1, 2, 3, 4, 5 wave correction, big correction down, retraces very, very nearly down to the 78.6 retrace of the whole move up from 2018 to 21. And this is particularly brutal, I think, for Autodesk. We saw a number of software stocks hit really hard last year. Salesforce was hit hard, Autodesk was hit hard. And I think probably this was hit hard because if you think about, well, why do you use Autodesk? You use it for new build projects of one kind or another. And for new build, you need cheap money. And what wasn't happening last year is cheap money. Money was getting more expensive. So I see Autodesk as something of a macro play as well as its own fundamentals. If people are engaging in new CapEx projects, lots of those are going to be designed in Autodesk. And you're going to need more staff designing them. You're going to want to buy more Autodesk seats. Well, this is what the stock's done since the June lows, and note the low was made in June last year, not October. That's my point about last year. Lots of sideways action from May onwards. So puts in a 1 up, peaking in August, sells down to a wave 2 low, a 78.6 retrace of that move up from June till August, and then it started to move up slowly in a wave 3 up. Now you can see from the volume spike here, you've got some accumulation going on, and the stock has briefly moved out of its accumulation zone, but pretty much it's hugged the upper side of this. And the accumulation zone is defined here by the volume. So what we're saying here is where big money is buying, that's where we want to buy. So we think that Autodesk can take a run up to at least 285. That will be a standard 1.618 extension wave 3 high, and it may take some months to do that, but we think that the fundamentals are good, macro backdrop is good, and once the depression comes out of this market, we think it can move up nicely. As you may have seen from disclosure alerts, I bought some more Autodesk personally today, just tiny allocation addition in the spirit of accumulation. No big buys in one go, just continuing to add small pieces as it moves sideways to this accumulation zone, trying to replicate exactly what large money accounts would do. So Autodesk risk reward looks pretty good. Stock closed today around 204. If you think that standard wave 3 upside could be 284, then you've got an $80 upside and maybe a $30 downside down to our stop zone, something like that. So a 2.2 to 1, something like that. And in fact, if you were to flow it all the way through to what the wave 5 could be, a significantly better risk reward. And that's the sort of opportunity that we like to present in the service, which is, of course, a stock can fall, any stock can fall. But if you like to use stops, mental or actual stops, then your downside compared to the upside on any normal technical measure looks pretty good. So we're happy to rate this one at accumulate. Let's look at the next one, Datadog. So Datadog observability software business competes with Splunk that was sold today. So we'd called Splunk in the service as an acquisition candidate for some time. That came through today, which is just terrific. So personally, I sold all my Splunk holdings today, be that common stock or Leaps. Leaps were a mighty relief personally, as I frankly overpaid for them, bought them at the wrong time, mentally written them off, and as it had cashed them with about an 18% gain, so that got a big few. For me, they were going to expire in January, so that's a nice, welcome and unexpected outcome. That Splunk was sold. We called for some time. I personally thought it would be a financial buy. It turned out to be Cisco, but good price and a good win for us. Datadog is a Splunk competitor. It's a newer business. It's early in its life still, really, and it's moving again sideways to this accumulation zone. If you were to look at the volume profile from those wave 1 highs, you can see that all the buying is down here. There's no volume up here when the stock was in free fall. All the buying is down here between about $100 on the upside and about 65 on the downside. Now, these high beta stocks, as you know, can be explosive. So if you'd bought Datadog at the post-IPO lows of about $28 a share in 2019, you would have made better than 6 times your money quickly within the space of a couple of years. No surprise, the stock sold off. If you look at where it sold off to the dollar, 78.6 retrace of that move up, found support there, and then has moved somewhat sideways since September last year in this accumulation zone. Briefly moved up into markup. I sold part of my holdings at that point for a solid, unexciting, but a solid gain. It's come back down again, and we're now back into the accumulation zone. Datadog, good solid fundamentals. It's going to win share in observability, and the sale of Splunk to Cisco will probably help Datadog win share. So again, we happily rate this at accumulate. The ratings might need an update on this, by the way, but this is accumulate rated. Wave 3, these long range wave 3s always look ridiculous when you draw these charts, but you can see from last time that these things can be explosive, and you can see from the, if you look at the NVIDIA chart, we haven't changed this chart for a year or more. We had it accumulate between 100 and 150 and a wave 3 high at 617, which looked insane when we did it. But, just look back. It's been a volatile stock between the middle of 19 and the end of 21. NVIDIA moved up from about $34 a share to nearly 350. So nearly a 10x between June 2019 and November 21. So a stock then can deliver nearly 10x in a bit over 2 years and then drop 80% of that value in the space of a year. Well, guess what? If it turns to the upside, it's probably going to be explosive on the upside as well. So although these long-range charts, they do look a bit stupid and fanciful, but they're often not, as long as you're patient and you don't mind a bit of volatility. So Datadog, continue to rate happily at accumulate. Cloudflare, another one, rocket ship all the way through 2020 and 2021. Moved up from the post-IPO lows of around $14 a share to $222 at the peak at the end of 2021. Dropped a colossal amount of that value. The chart here traces from a notional $0 a share. It's just a modeling artifact, of course, up to that all-time high of 222. It dropped more than 78.6% of that value through 22, and then it's just bumbled sideways, as you can see, since May of last year under accumulation. And again, all the volume is down in this price range. So this is where we think that bigs are buying. And again, these long-range wave 3s look stupid until they don't. So we think that this one can really start to move up. Good and improving fundamentals, has yet to really respond to the bull market in 2023. My opinion on that, by the way, is because it's a small company, relatively illiquid stock, and it takes time to build a position in that if you're a large account player. But if you are a large account investor and you invest in software, you can't not want to be in net because it's a structurally important stock. It's likely to do well, and you won't want to have missed out on it. So you're going to want to take some time to get into that. During Net's various peaks in the last few months, personally, I've sold down at solid gains some earlier positions, but these prices now I'd consider adding to it. Haven't done so yet, haven't decided to do so, but I'll have a think about it. But this is back into accumulation. So far we've done Autodesk, really good, rock solid business, likely to move up with as CapEx projects come through, as money gets cheaper. Datadog, share gainer in observability. We've done Cloudflare, which is likely a share gainer in two things, application hosting and distribution, and zero trust security networks. So these are all good companies, good fundamentals, we think likely to move up for good reasons. Okta, and what we're about to talk about, PagerDuty, a bit different. So Okta is a cybersecurity business. It's, as we've documented extensively in the service, the company's had its problems. So it was a really rock star of a company between 2016, 17, and 2020, when it was basically developing and selling its own products. They made, in my opinion, a terribly planned and even worse executed large acquisition, a $7 billion acquisition of a company called OAuth, which was a direct competitor. Did everything. If you read, how to do M&A well, they did everything that book would tell you to not do. So they didn't solve the hard problems about who was doing what, didn't solve the hard problems about which products get taken to market, which customers are by whom and on what price schedule, and so on and so forth. They just almost left everyone to get on with it. Their due diligence was poor. That's not an opinion, that's a fact. Evidence, they found a big hole in deferred revenue. Well, that shouldn't have happened. Deferred revenue is relatively simple to measure. CFO went. The sales team has been churned at Okta, and the only person that hasn't gone is the CEO, which is odd in my view. I would have thought that the board would be pushing for a replacement, but so far not. Okta has been on the climb. Fundamentals have improved a little bit of late, not great, but a bit. Stock's been moving up more than, in my opinion, is justified by the fundamentals. And given that we've seen good, strong companies like Cloudflare really not move up this much, you'd have to say, well, what's afoot here? And my own opinion is Okta's an acquisition target. Cybersecurity is being continuously rolled up by strategic and financial buyers. I think Okta is probably on the block. And the reason I think that is because it gets everyone out of a pickle. They can declare success if it's sold to a financial or a strategic buyer. And it means that the hard problems in the company that have not, in my opinion, been solved don't have to be solved. It's somebody else's difficulty. And so everyone gets covered with glory and can declare a win. We'll forget about the fact that the stock was $300. We'll look at the fact that the stock was $45, and the folks involved can declare success. So my guess is, it's only a guess, that this is an acquisition candidate. If it were bought tomorrow, we might see the stock bought at $120, $130, maybe more, something like that. It's possible that it continues as an independent company and the stock can move up. In the case of Datadog, my own opinion is I'd rather it did that. I'd rather it wasn't acquired. I think it has great organic potential. Okta, I own it. I have an underwater position. And my own view is if somebody were to come along and buy the business, I'd be pretty happy about that, because it would just put the team out of their misery, and the stock as well. But we're happy to rate it accumulate at these prices on the basis that something is afoot there, something's driving the price up, and something's driving this volume as well. Just look at, again, the volume spike is down here. Look at the gray bars on the right hand side, and if you were to measure it from the lows, yeah, you can see. I mean, look at the spikes here. Start at the all-time high. There's no volume up here. It all starts down here, and so that's, people are starting to buy it here back in May of last year. Again, my point about the market starts to go sideways from May, and this is big money speculation right here, in my opinion. So Okta, I think, an acquisition candidate. Not very good fundamentals. Plenty about the company to not like. Doesn't mean the stock can't go up, particularly if it's bought. PagerDuty, same story for different reasons. Good enough, decent little business. It's basically an alerting vendor. The company's failed to build itself into ever wider niches. What you need to do in enterprise software is, if you have a niche positioning to begin with, and most do, then you need to either by product development or by acquisition expand into one standard deviation to the right, one standard deviation to the left, and continue to broaden out your positioning within the enterprise so you can take more and more spend from the enterprise wallet. Well, PagerDuty has completely, in my opinion, failed to do that. Now, what does that mean? I think they'll get bought. And I think they'll get bought because it's a point solution that really belongs in the suite. And if they're not going to develop their own suite, then somebody will develop it for them by jamming it into their own. And so I would expect, again, this company to be sold. It's a small business. I forget the EV, but it's $2, $3, $4 billion EV, something like that. And so this is just a tiny tuck-in for someone. So we rate this as accumulate, not because the fundamentals are great, they aren't, not because the organic prospects of the stock for the company are brilliant, they aren't, in my opinion. But I do think it's the sort of enterprise software company that's likely to get acquired at some point. Pinterest, we don't do much in consumer here, mainly because I don't understand anything about the consumer, but you don't need to be a consumer expert to look at this and say, well, that thing's under accumulation. They brought in an activist investor, Elliott Advisors, a couple of years ago now, and since then, absolutely everything's been thrown under the bus that should have been, including various members of the management team. The fundamentals have improved no end. They're using a ginormous cash pile that persists from its IPO to now do buybacks. And again, if I were to guess, I think this thing will be acquired. It has a vast user base that's not particularly well monetized. And again, look at the stock behavior here. Since the lows that were struck again in May last year, not September, not December, but in May last year, it was one of the first to bottom. This thing's been trending sideways with a big volume spike here. And I would see again that as accumulation, ready to move up. So we rate Pinterest, PagerDuty, and Okta and Accumulate, all basically for the same reason, which is they're not desperately good businesses, but there's a good chance they're acquired. And the trouble with buying for a company to be acquired is your upside is kind of capped. So you're unlikely, in my opinion, to make 100, 200, 300% on these things, whereas with an Autodesk or a Datadog, that's really possible. But the upside of 30, 40, 50% from here in each of those is very possible, in my opinion. Two more to go. Qualcomm. So Qualcomm, semiconductor business, as you know, focusing on RF comms. If you buy a cell phone or any other wireless device, some part of the technology in there has almost certainly been developed by Qualcomm, and someone somewhere is paying Qualcomm a license fee for that. The stock had got hammered for all the usual reasons, plus which they were losing big wallet share from Apple, who was in the process of developing their own modems and eclipsing Qualcomm componentry. That's changed. Apple just extended their contract with Qualcomm by, I think, 3 years from memory, and that's helped to support the stock. This is now trending nicely sideways in this accumulation zone, and we think it can move up well. So if we just set this volume clock again at that all-time high, again, you see declining, not really much volume here. As the stock comes down, volume starts to pick up, but the real pickup is between about 126 a share on the upside and 108 on the downside. So we have it accumulate between 122 and let's call it 105 and a stop zone below that. And probably Qualcomm's not going to explode to the upside. It's probably one to be patient on, but we do think it can move up nicely. And so again, these long range wave threes look stupid when you draw them like this, but then it would have looked stupid if we'd said that from January 19, when the stock was at $50, that it was going to reach 193 bucks a couple of years later, 3 years later. So high beta stocks are volatile to the downside, as we know from 22, but they're also volatile to the upside, as we should know and remember from 2019 and 2020. So will this get to a couple $100 a share tomorrow? No. Can it get there over the course of a couple of years? We think it can. It's probably too big and too strategic to be acquired. There would be there was a whole lot of acquisition activity around this one in 2018, and it was shut down by regulation. That probably happen again. So I wouldn't count on this thing being bought, but can it, fight its way out of this through organic execution? I think it can, yeah. And the last one, Zscaler, ticker ZS. So this is a new take on this chart here, simpler chart. And we just chart this as from the 2020 lows, the COVID lows of wave one up, where the stock moves from 35 to over 350, so 10 times your money between March 2020 and November 2021, not too shabby. It then drops nicely to the 78.6 retrace, a little bit below, and then started to move up again in what we think is a large degree of wave three. And again, so the same thing again, large degree of wave threes look stupid when you draw them. They don't look stupid as when they happen. They look like, oh, of course that was going to happen. It's 1.618 extension of the last wave one high, placed the way too low, but they look stupid when you draw them. So I don't think anyone can look you in the eye and say this thing's going to go to $600 a share, but it might do. And it's not complete fantasy to say that. So for now, accumulation zone between about 82 on the low end and about 170 on the top end. That just matches the volume spike here. So if we set the volume clock at the all-time high, again, no volume up here, all the volumes down here, and we think this one can move up really nicely. If you look at the stock, in the middle of this market sell-off, it's held up really, really well. So, it's at 148 now versus a peak of 169 in recent times, and so it really hasn't dropped very much at all. That tells me that someone's serious about building a stake in this thing. So that's a select handful of stocks that we think the risk reward is pretty good on. So just to recap on fundamentals, Autodesk, Datadog, Cloudflare, we think good, strong, solid companies that should be able to move up. Zscaler 2, Qualcomm 2, although it's probably to a lesser extent. And then acquisition candidates, Okta, PagerDuty, and Pinterest. All of those are accumulator rated, and we think the risk reward looks good at this point. Okay, folks. Questions, right? I have a couple of questions in chat here. So chart larger on the screen. Hopefully that dealt with that. But if not, I'll post charts later on. How about DigitalOcean? Yeah, good question. So I own a little bit of this, not much, but a bit. Let's have a look. Yeah, it doesn't look pretty. So yeah, in the stop zone. So I personally haven't stopped out on it. I don't know much of it. And so I've just sort of leave it where it is really. So it looks like it's back to the January lows. That's not fatal necessarily. So we've just got a one up and a two down, and maybe we have to start with another one up again. If the market does go up, this most likely will get dragged up with it. So I wouldn't hang my hat on this being a dramatic performer. But again, I own a little bit of it personally. I'm happy just to leave it where it is in the expectation it moves up over time. AMD, question in chat. Hold on 1 second. It's like Kramer lightning round. Yeah, still in markup in hold. That's a really bullish looking chart if you ask me. If you look at the move up from the lows, and the fact that where we peaked 132 and we're now down to 96, in the teeth of this sell-off, that's not so bad. So we are back to the price last seen in May. I mean, you could certainly convince yourself to buy that one, I think. Technically a markup and hold rated, but yeah, that's a bullish looking chart, I think. So hold rated, but yeah, good discount on where it was. Okay. Any other questions, folks, before we wrap up for the day? Just check the questions in the webinar platform here. No. Okay. All right. Well, look, let's just go right back to where we started, which is to say it's obviously a sell-off environment right now. You've got all of financial media freaking out. And I mean, you have to remember the point of this is to try and spook the civilians into selling things that big money can buy cheaply. That is the point of the market. The market is a ginormous transfer mechanism. It's designed to transfer money from small accounts to large accounts. That's what it's there for. That's what the financial media is there for. And so do your own work. It could be that the market's going to fall off a cliff. You need to have a plan for that, be prepared for it, whether that's realizing cash or hedging or using options to engage in protected positions, whatever it is you like to do, you need a plan for that. But right now, to our eye, that isn't where we are. Where we are is a pullback in an overall move higher. So all I would say is do your own work, put your own thought in. Don't be told what to think. Sit back in a quiet room and make your own decisions and your own judgments and act accordingly. And whatever you do, don't get freaked out by all the noise on Twitter. Okay, folks, thanks for showing up today. And as always, really appreciate you being a member of the service. We continue to be just delighted and flattered at how well the service is growing. We've done well through bull markets, bear markets, sideways markets, and that's just great to see. So thanks everyone for being a member here. Look forward to seeing everyone in chat later on. And as always, we'll post the recording once it's done and compiled in a couple of hours' time. Thanks, folks. See you all later.